Of the 33 finalists, half of them, or 13 of them, have come from 9 different countries. The winners have even come from universities such as Stanford, one in Milano, Italy, the London School of Economics, Columbia University, Macalester College, the University of Akron, and Emory University. So we've had a real good presentation. It's been very interesting, and we feel a very fruitful activity. Over that period of time, we've also had about 90 judges from 22 different countries participate. And the way that we pick the judges is the society has a mailing list of about 30,000 names, or access to a mailing list. And we broadcast an invitation to any economist in the world that wants to be a judge in the competition. And we generally take the first 20 to 25 respondents and then separate them into 2 groups. Now, the first group is what we call the first order of judges, and the purpose for having them is to do a sifting and a winnowing down of all the different entries that come in. We've historically had 50 to 65, 70 entries per year. But if you think about how much work that is, if you just have 50 entries and they're 20 pages long on average, then you're talking about 1,000 pages of text to take a look at. And these aren't just average undergraduate student papers. These are usually honors theses, senior theses, and so forth. They are ones that have people have put a lot of effort into, and they're exceptionally high quality. So from the 30,000 invitations that we sent out, we ended up with about 21 judges for this year's competition. The judges who couldn't attend the competition were the first panel of judges, and they winnowed it down to 4 of their best papers, the 4 that they liked the most. And that is pretty difficult job as it is, because the papers are such high quality. In fact, one of the judges this year said, "Here's my favorite 4." He said, "But I got to tell you that I am really feeling guilty about not being able to choose some of the others as well. That's just sort of the way things have gone." At any rate, here we are at this year's competition, and each one of the finalists has had a letter of financial support from their university, which is really a neat thing to think that the universities are getting behind their students and willing to sponsor them their travel and their lodging to an event like this. The students have come from all over the world. One of our students today came from Beijing. Another one came from Denmark. So, and 2 in the middle in the United States. So, that's a pretty good range for the competition. So we've had 21 judges this year. They're in 8 different countries. And I think we now have winnowed it down to the 4, and we're ready to go. And you've probably heard enough from me. So we're going to turn it over to our first presenter, and that's going to be Angie Chen. And Angie's going to be talking about the effects of changing housing prices on retirement likelihoods, which was of interest to me, getting closer and closer to that date. Okay, Angie.
Well, good afternoon, everyone. I'm Angie, and I'm from the University of California, San Diego, and I'm here today to talk about the effects of changes in housing and real estate wealth on retirement likelihoods. So, motivation and importance. Why am I talking about this topic? you might be sitting here thinking, what is this girl in her 20s who's barely entered the labor force researching about retirement? She hasn't even started and she's already thinking about leaving? Well, that's great. No, the reason I'm researching about the labor force is because I've always been interested in the labor market and how changes in assets affect participation in the labor market, whether those assets are welfare or income or real estate. And why am I interested in the real estate market? Well, I lived in Hong Kong for 4 years, and for those of you unfamiliar with the Hong Kong real estate market, I looked it up, and currently the price per square footage is $2,000 US. So all of you are sitting around on about $8,000 worth of real estate in Hong Kong. And my interest in real estate kind of goes further, and right now I like real estate so much that I'm a commercial real estate analyst. So for my research, I analyzed data from between 1992 and 2010. And that was really convenient because that allowed me to use two natural experiments, the housing boom and the housing bust. So between 1995 and 2006, there were dramatic increases in housing prices. In 2006, the average inflation-adjusted housing price rose by 50% since the mid-90s. And in certain metropolitan areas, that was 90%. $5 trillion in bubble wealth were created, and that's going to average out to around $70,000 per family of four. In addition, increases in financial products allowed households to access this real estate wealth easier. But everything that goes up must come down. In the years subsequent to the bust, the Case-Shiller index dropped to about 34% from its peak by 2009. So why is this all important? The housing wealth and housing and real estate wealth is an essential wealth effect. So the crude definition of wealth effect is increases or decreases in consumption that corresponds with increases or decreases in perceived wealth. So changes in housing wealth will change perceived wealth. And when households think that their perceived wealth has changed, they may make changes to their labor market decisions and consumption behavior. With 65% of Americans owning households, problems with long-run trends in the reduction or the delay of retirement timing may put pressure on old age welfare benefits such as Social Security and Medicare. And it also puts a strain on the financial security of those that are retired. So this isn't new research. There has been research done on this before. This table kind of outlines some of the research done and how they defined the changes in housing wealth and changes in behavior. Now, these studies were done in different time periods and across different countries, and some measured intensive margins while others measured extensive margins. But the general trend was the same. Increases in housing wealth decreased there's a trend in reduction of work. So in summary, increases in housing wealth made you feel richer. My findings were that higher levels of housing or real estate wealth, or the net values, predicted a lower likelihood of retirement at any given time, holding all else constant. Now, I was actually interested in is the percentage change of net values, because that is more correlated with the boom and bust cycle. And so I found that large percentage increases in housing wealth predict that individuals were more likely to retire. So this suggests that housing bust may have delayed retirement for many households. The data that I used was the RAND HRS data file, which is a clean version of the University of Michigan's Health and Retirement Study. Now, this survey is a biannual survey that was conducted from 1992 to 2010. I did some data cleaning and cleaned out about 20,000 respondents, and I cleaned them out because they were retired before 1992, or they were too young to make a retirement decision even at 2010. I also cleaned out extreme data points. I merged in the FHFA housing price index data and the BLS regional unemployment data to control for biases. From there, I was able to construct different work histories, continuous work histories, to run my hazard models on. So before we get to hazard models, let's look at a cross-sectional plot of the data. So I took key dates, 1994, 2004, and 2010 from the time period. And as you can see, there are changes in trends of retirement age over this 20-year period. So if you look at 1994, which I would say as a control year, there is this shape to the graph. But relative to 1994, if you look at 2004, there is, which I would consider as one of the peak years of the housing boom, there was a significant spike in the proportional number of people who retired at the age of 62 and at the age of 65. Now, comparing 1994 and 2004 to 2010, as you can see, there is a dip in the proportion of respondents who retired at the age of 62 and 65, which are considered the standard retirement ages, and there's an increase in the proportion who retired later, around the age of 70. So I chose to use the hazard model because it is a fitting method in measuring likelihoods. And hazard models give instantaneous potential of an event, which is retirement, to occur, holding all other variables constant. My sample data assumed that it was comprised of n independent self-reported age at the age of first retirement. And that's the instantaneous potential given. And this probability that an individual retires in an interval of t and t plus delta t, given that they have not retired at time t. So I estimated the equation at the bottom with RIT is a dummy variable of whether the respondent had retired at that point in time, HIT being the different housing and real estate wealth measures, FIT being the vector of non-housing financial wealth variables, and WIT being a wellness based on the respondent's self-reported health in the wave. XIT is a vector of demographic variables, and GIT is a geographic control variable determined by the census division unemployment data. So I tested both the Cox and the Weibull models, and they found similar hazard ratios. But the results of the Weibull had significantly higher log likelihoods. So the results are from the Weibull iteration. So as you can see, $100,000 increase in net values in primary residents decreased the likelihood of retirement by 8%. For primary and secondary residents, it decreased the likelihood of retirement by 6%. And for all real estate, it decreased the likelihood by 3%. Now, the second set, the change in net values, which, like I mentioned before, is more associated with the boom and bust cycle, a 10% increase for primary residents resulted in a 38% increase in likelihood of retirement. For primary and secondary, increased likelihood of retirement by 19%, and the result for all real estate was not statistically significant. So these results suggest that although housing wealth is still relatively illiquid compared to other forms of financial wealth, especially for older workers and those that are retired, individuals are still very responsive to fluctuations in housing and real estate wealth. An explanation for this is that large increase in housing and real estate wealth serves as a form of reassurance or potential safety net. Positive correlations may not be that households are extracting their gained housing wealth and using it in retirement, but rather they consider it as a form of financial security during retirement. So relating these results back to my cross-sectional plot, in spite of considerable increases in the housing and real estate wealth, the proportion of respondents who chose early retirement did not necessarily increase. Rather, there was a noticeable increase in the proportion of respondents who chose to retire at the standard ages of 62 and 65. The housing boom, hence, did not necessarily encourage early retirement, but rather may have allowed for normal retirement by providing a sense of security in retirement, because people might think, worst comes to worst, I'll at least have my house. So other interesting findings from my research is controlling for all else. Males were 23% to 24% less likely to retire than females at any given time. White respondents were 19% to 20% less likely to retire than other races. Being married makes you 44 to 50% more likely to retire, and a 1% increase in regional unemployment made you 23% less likely to retire. Thank you.
Now, we have judges here today, and we're going to allow them to ask a question each on the paper. So who would care to start?
I'll start.
Okay. Oh, there we go. We're looking for a microphone. Found it.
We
Yeah.
found it. Okay. So my question, and I'm asking for speculation, not like some sort of definitive answer. I don't expect you to research this on the fly. The analysis that you've done is rather coincident, right? That you're looking at my decision to retire now and my house value now, or what's been happening to my house value now.
Yes.
Whereas not being so close to retirement, I can imagine much longer term implications for how real estate value might change through my life cycle. That would impact my decision in terms of when to retire.
Yes.
We know, and you mentioned in your paper, the idea that people tend to actually consume a fair amount out of increased real estate wealth, and not their retirement assets though. So like not stock value increases, but real estate value increases.
Yes.
That sort of makes me think, gee, okay, I'm not going to borrow against my 401k to buy stuff, but I take that home equity loan and buy stuff. So I'm just asking, like, speculate on that, because I think this is really interesting. That clearly, like, this year, if something happens to my house value, yes, that might change my decision to retire or not. I'm saying. But can you speculate on how real estate trends, particularly like the really big boom and then the succeeding crash, which no one I think expects to recover in the near term. I own property in some of these places, and we think the prices will go back up, but not to where they were because they were crazy, right?
Yes.
How might this impact my long-term decision about when to retire or my financial plans?
Yeah, absolutely. So what I measured was actually the instantaneous housing price or real estate wealth versus decisions to retire. Now, obviously, as through the cycle, as each respondent's housing wealth changed, that probably changed their expected retirement time. And so in my study, I did cut out the people who were probably only 40 or 50. And so it would be very interesting to see how their expected retirement times changed throughout the cycle, even though they were pretty far from retirement themselves. And I would think that, there's probably, if you plot it out, you expect your housing wealth to, increase by 3% every year, and you plot that out, and you think, well, by the time I retire, that's going to give me X amount of money to retire on if I take a reverse mortgage or something. But obviously, these things will change as the market changes. So that's my best speculative answer for that.
I don't think I need a microphone, but I enjoyed the paper very much. I have a question about those mortgages that exceeded the value of the house, which was a common event in the time period in which you did your survey.
Yes.
And how was that accounted for?
Yes, absolutely. So I took the net values of the real estate. So I took the valuation and subtracted out any debt. So it is possible that some people would have a negative net value for their real estate, but that wasn't very common. Not in the survey data. So.
On the time, that's in the near future, very short term. Let us say for next 2 years, what is your expectation that, okay, from your analysis, what will be the impact on the employment?
On employment? So the effects of changes in housing prices on employment? If we go back, let me just pull this back up. What I didn't mention was sort of the long-run trends in employment. So there seems to be, if I plotted out all the cross-sections between, after 2006, there actually seems to be an overall delay in retirement, a long-run trend of delays in retirement, whether that be because of changing Social Security policies, whether that be because cause of the housing market and the decline in housing prices, or just a cultural change of people delaying retirement and working to the age of 70 or maybe 75 later, and by the time that we retire, it'll probably be 85. But there does seem to be a long-run trend in shifting towards later retirement and not retiring at 62 and 65. So I do see that perhaps continuing in the next 2 years.
I'd like to ask a question also, and I think you can probably hear me from there, so I'll talk real loud, okay? But you mentioned that if you use your housing wealth only, you're 38% more likely to retire early. And if you had housing plus financial wealth, it was only 19%. What accounts for the difference?
Oh, so it's not housing plus financial, it's what I meant by primary plus secondary, so it's people who own multiple houses.
Oh, okay.
So it would be your primary house, the one that you lived in, and some outside real estate as well. And my guess on that is not many people will have beyond your primary real estate ownership. And so those people who have beyond primary real estates would probably have higher paying jobs. People with higher paying jobs might enjoy their jobs more. They're probably not working minimum wage. And if they enjoy their jobs more, they might not be as tempted to retire early or retire at the ages of 62 and 65.
Okay, very good.
Right.
Thank you.
Thank you.
So good evening, everyone. Welcome to the conference. My name is Boris Georgiev, and I am from Aarhus University in Denmark. So today what I'll be talking to you about is basically financial economics, portfolio optimization, and why this topic is really important. Well, first of all, let me define the problem for you. What we really want to do as individuals, we want to maximize our expected return for the holdings that we have, but we do not like risk. So in other words, everybody in the economy is risk averse, but we don't exactly know how risk averse each individual is. So this would actually very much affect our investment decisions. So for that reason, what we in fact want to do is we want to trade off exactly risk and return. We dislike risks, but we like high returns. So let me perhaps motivate this problem even further by saying that in fact this is a very important question right now, because as you can see, investing in risk-free instruments such as bonds may not be that attractive anymore, having in mind that we're very close to the zero interest level bound. So for that reason, I came with this idea to try and propose a better return estimator, which would then help us basically devise and manage our portfolios better. Why is it important? Well, this is basically important because we want to make sure that in what we invest would provide us with the best returns, and it will also take account of the risk that we're willing to take. So for that reason, as I already said, is there any way how we can start investing in a better way? And this also has a societal dimension, because if we're all able as individuals to manage wealth better, then this simply means that we'll make more people better off. So this would play a very, very important role. So let me perhaps tell you about the 3 contributions that I achieved with this paper. First of all, I devised an alternative return estimation model that I'm going to introduce you in detail a bit later in my presentation. Second of all, I propose and test on real data 2 alternative strategies for investment. The first one is what I call the Max S strategy, or you could perhaps, for the people that have been within the field of financial economics, you have heard about the Sharpe ratio. So in other words, as you can see from the slide, simply we want to maximize the expected return over the risk-free asset divided by the standard deviation. Whereas the second strategy that I propose is the so-called maximized information ratio. This ratio, as you probably can see, is very, very similar to the first metric. However, the only difference is over this RB, and this is the so-called benchmark criteria. So if here we had the risk-free rate, here we have the market. And we'll see later on what do I take as a proxy for the market. So now if you see what we're actually trying to do, we're trying to maximize the excess return over the market return divided by the standard deviation. So even though these two strategies seem similar, they're not exactly the same, and we'll see what are the implications. My third contribution is that I have been able to apply to my portfolio strategy and as well to my optimization model an improved covariance estimator that has been proposed by Olivier Ledois and Wolf in 2003, and this is a so-called shrinkage estimator. What a shrinkage estimator means is simply that you don't only use the typical historical covariance estimator, because if we only do that, then we miss key aspects of the data, meaning that historical covariance estimators do not capture perfectly the co-movements between assets in the asset universe. And as I already argued, in order to be able to really select the assets that we want to include in our portfolio, we need to make sure that we also take into account the way they covary. So it's not always that we take the asset with the highest return. So these are the three contributions that I have made. So now let me perhaps continue further and introduce you to the methodology. In order to fulfill this project, I have been relying on quadratic programming techniques as well optimization methods in order to construct my optimization model and as well also to backtest it for time. So basically I have implemented all this in MATLAB. Furthermore, I have estimated the time series of the capital asset pricing model. And why we need this is because, in fact, the CAPM plays a key role in my own estimator that I'm going to introduce to you very soon. So here below you can simply see this is the so-called time version and the time series version of CAPM. You can also estimate it using a cross-section, but the time series version gives better results. So you reach closer returns than the ones that are actually on the market. So now perhaps let me move forward and introduce you very slightly to the theoretical formulation of the problem. So as you probably can see, what we have here is that we want to maximize the expected return of our Sharpe portfolio. So now I'm talking about the first strategy, given some constraints. So the first constraint is that what we want is the so-called full investment of our budget. In other words, if you have $100,000, you want to make sure that you invest the entire amount, that you don't have any slack. So if we take psi as indicating the individual weight that you and percentage that you invest in every single asset, then you want to make sure that the sum of all your investments equal 1, right? So that all the weights sum to 1. And this simply, the second constraint here tells us that what we want to do is we do not want to short sell assets. After all, here we're about long-term investing, so we don't want to take the speculative role here. So that's why we want to make sure that we always invest positive amounts, meaning that we buy long. The last constraint is related to the variance, and this is perhaps also an important point because this will at the end tell us what actually risk level are we willing to accept for this maximized return. And here is the point where I also have to show you basically that this return, this expected return, is something that I estimate with my own estimator that I derived, and I'll introduce you very shortly to it. And the second aspect is already what I mentioned to you about the portfolio ratio. We do the same. So in both strategies, I use my estimator. And finally, here we have the covariance matrix, which I already mentioned that I have used an improved covariance matrix estimator that has been derived in the literature. So in other words, I combine two things into one. Now let me show you a little bit of the data. I've been using daily data, which of course is very valuable because we're able to track changes in asset prices on a very, very low time interval. So here I'm dealing with approximately 5,796 observations spanning from around 1990 in March until very recently actually. Furthermore, for the risk-free rate, I use as a proxy the yields on the 5-year Treasury bonds from the US. As we know, in order to estimate the CAPM, we need to have the risk-free rate and also the market return. So we need something to put into the CAPM model to get this estimate. Whereas for the market, I take the S&P 500 index as a representative of holding all the stocks on the market. And of course, here you can see a log of the prices and how they have been developing throughout this time. So two things become immediately evident, and the first thing is that, as you can see, two busts, I guess you can see them immediately. That's here is the dot-com bubble burst, so you can immediately see a big decline in the S&P and NASDAQ indices, as well as a drawdown in the stock prices in this area. The last one, which is perhaps even more evident, is the impact of the financial crisis around 2008. So you can see basically without any exceptions, all assets had a huge decrease in their value. So this is the data we're dealing with. And next I would like to present to you our representative investor, or you could say the representative agent, which stocks does he consider. In my analysis, I consider 30 stocks. Here you can see which are those stocks, and they have been randomly selected based, however, on a criteria of liquidity and also trading frequency. And why this is important is because when we hold assets and when we also have to rebalance our portfolio quarterly, this is the approach that I have taken here, we want to make sure that the assets that we hold are highly liquid. In other words, we can easily sell them or buy. Furthermore, as you probably can see, most of the firms included are large cap stocks. And this as well is pretty important because we want to make sure that when we buy assets that we do not affect the price ourselves, because if we buy shares of a very, very small firm, we in fact risk by our own decision to buy these shares to change the price. So we want to make sure that we hold big enterprise firms. This has been the rationale. So in this case, as well, I have grouped the stocks into specific categories. So as you can probably see, we have groups such as technology stocks, aviation and defense, financial services, etc. So this is an entire universe of 30 stocks, among which now we need to select and see how does the optimal portfolio look like. And now, before I continue further, I want to introduce you to my key contribution to the literature, and this is my return estimator. Now, before perhaps you start digging and trying to understand it by yourself, I would prefer to guide you on through. So the way I'm going to do it is I'm going to introduce the notation. Furthermore, I'll introduce you the role of each of these variables and argue why, in fact, this model captures the actual returns in a better way than what we have seen so far in the literature. So RH, in this case, is a so-called historical return. In other words, what I do is I take a 2-year rolling back window, so when every 3 months, when we have to reinvest, we take 2 years back historical window. So this is the first, so in other words, we take the historical average of each asset's return for the past 2 years. Furthermore, what we do is we take the RC, and RC is the CAPM return. And as I already mentioned, we obtain these returns by running the time series regression. So for each asset, we obtain some kind of a prediction coming from this model. Immediately, you can also see that the terms in the square brackets are in fact weights. All they sum up to 1. And so you can already start feeling that our estimator is basically containing 3 separate estimators. The third one is perhaps the novelty, the really big novelty here, and that's the so-called fundamentally estimated return. This return is not spelled out simply from a pure mathematical model. This return is something that I call fundamental because it's based on the fundamental business of each firm. And why this is very important? Well, the reason is that you cannot simply expect a specific return on an asset without really knowing and taking into account what does the individual firm do, how well does it run its business, how innovative it is, what type of product it has, and so on. So let me, for example, give you a very, very short illustration. How would you expect that Apple would have had such a big growth starting from the year 2000 if you did not take into account the leadership role, the management team, the innovation, and the innovative products that they launch? So in other words, if you simply took historical returns for the CAPM predictions, that in no way would have been a good account for their actual return performance. So that's why this forward-looking component, REF, plays such an important role in this setting. So the final element is the gamma. Now, gamma is something that I call, you could say, confidence, information, agreement variable that basically ranges from 0 to 1. What this variable captures is how does the individual investor take this REF estimate? How much are you personally in agreement with it, with this estimate? So in other words, if you read a report and you obtain REF that is, let's say, 10% for a given stock, but you do not entirely share the same market outlook, you do not believe yourself that the return will be as big as it's indicated, then your gamma would not have a value of 1 because you don't believe in 100% in this estimate. So your gamma will be lower. And the beautiful element about this estimator is the following. Let's take a look here. So by varying gamma, you can never make the first fraction become 0. And this is very formidable property because you want to make sure that, for example, if REF is not available, imagine you chose a stock that simply there is no REF provided for it. So then what do? Well, you won't get an estimate of 0 that you're going to put in your optimization model. Well, you'll simply get the weighted average of the historical and the CAPM returns. So you see, because if gamma is 0, then your denominator is basically 1, so what you're left with only is this upper part. Whereas let's take the extreme case. You get an expected fundamental return, and you share absolutely the same vision and the same direction of development of this stock. Well, if your gamma is 1, and this here is 1, then your denominator will become 2. So in other words, what you're going to get is simply an average between both fractions. And perhaps it will give you a bit more sense if we take a look at the dynamic aspect of this estimator. So this is how this estimator looks if you take, for example, some given values for RH and the return from CAPM. So imagine we have the stock, which historically we should expect a return of 5%, and the CAPM predicts 8. Now let's see if we change gamma and REF, what is going to happen with the final return that we'll have to input in our model. So let us take a very brief look here. For example, if REF, we in fact share a much higher expectation of 15% in this case, but we are not confident at all in this estimate, well, we see that the result that we're going to input into the model is simply a weighted average between RH and RC. However, if we get an estimate of 15%, and we become more and more confident in this estimate, we see what happens with the final estimate that we put. It very gradually approaches 15, but it will never in fact be equal to, because we also need to take into account the RH and RC. So as you probably saw, we can never ignore them. So this simply here shows you the dynamics of this estimator, and I have tested it on data, and it seems actually to perform pretty well and approach the actual returns pretty well. So let me now introduce you to the constraints that we consider, because you as an investor, you want to make sure that you do not overexpose yourself to, let's say, individual industry risks, or you want to limit your investment sometimes because, for example, you don't want to overinvest in one specific stock. This is why, here as you can see, I have devised a couple of constraints. Basically, we have an upper and lower limit bounds. In other words, what we require is that we never invest lower than 10% in technology, aviation and defense, and as well financial services, but we also make sure that we do not invest more than 60, 20, and 15% respectively. Furthermore, we do not want to invest more than 30% in a single individual stock. And finally, I also modeled transaction costs, which is also a novelty in this particular framework, because as you probably imagine, every time you transact, there is something involved, such as, you could say, brokerage fee that you get charged. So in fact, you don't get always the entire return. In fact, you get lower. So by modeling this, and I model it as a function of the price, and the average on the stock exchanges have been around 12 basis points. So this now also introduces another aspect of our model, that it always weights the beneficial effect of retrading, in other words, rebalancing our portfolio, with the expected return that it's going to get. Because, of course, if the transaction costs exceed the return, then there is no purpose in rebalancing the portfolio. And this is simply to illustrate you the asset universe and what is the impact on the efficient set. In other words, along this blue, dark blue curve are all the efficient portfolios that an investor can choose among. So as you can see, as soon as we incorporate these additional constraints to our primary optimization model, we see an immediate drop in the efficient frontiers. And now actually our investment potential becomes much lower. So now here you may wonder, okay, but why doesn't the dotted red line, which basically indicates risk-free rate, why is it not starting from from here, from the risk-free rate, as it does here? Well, the reason is that, as you remember, when we incorporated the constraints, we required at least 10% to be invested in 3 groups. So in other words, now the model cannot simply invest more than 70% in a risk-free rate. So this is just to give you the intuition why does the figure become smaller. Furthermore, as you remember, we introduced these additional constraints related to over-investment. So this is why those 2 figures look a bit different. However, these constraints are important to be incorporated because what we also want to do is we want to take into account, for example, investors' risk aversion. So if you do not constrain the model like this, now please take a look at the left figure. Well, you see that there is, in fact, an optimal portfolio that basically includes entirely only this asset. And NVO stands for Novo Nordisk. And we don't want this because then the model will going to tell you, well, you need to invest 100% in this asset. But probably you would be, I don't think anybody in this room would be willing to invest all his fortune in only single assets. So we want diversification. Just to show you that these points here are optimal, let me very briefly show you here the Sharpe ratio and the information ratio. So these are the same frontiers from the other figure. However, this is for the information ratio. This is for the Sharpe ratio. And this simply shows the evolution along this efficient frontier of the Sharpe ratio. So you can see that we always choose the maximized. And this is what, in fact, we wanted to do from the beginning. Below, you can see the performance of each of these portfolios. So you can see that if we were following the max S, then we would have definitely performed much better than the market, also better than an equally weighted portfolio in the bottom. However, getting the higher return following the max S strategy has its own risks. As you can see, the standard deviation is actually more than twice higher than the standard deviation of the max I. So you see, this is why I meant that the max S could be, in fact, a strategy tailored towards more aggressive investors, people that have less risk aversion, whereas the max I would have been a strategy towards more prudent investors. This is again to give you an illustration how, in fact, do these optimal portfolios look like, right? We want to know how much shall we invest in each individual asset. So what probably immediately makes an impression here is that the max info ratio portfolio seems to be much more diversified, right? You can immediately see that many more assets, in fact, enter this portfolio compared to the max S. Another interesting point is that you probably immediately see the binding constraint. You remember we said the constraint that we do not want to invest more than 30% in any individual stock. So you can see here that this constraint is binding. So perhaps even though it may have been profitable to invest more in Novo Nordisk, we have not done this because then our ratio would not have been maximized. Now, after I have introduced you to the terminology, as well to the data that I have used, the optimization method and model, it's perhaps time to take a look at the evolution across time. So before, of course, you invest, you want to make sure that you have benchmarked your strategy across time. So what you see here, this figure is basically many efficient frontiers estimated at different points in time. And the yellow line here, actually the yellow curve, links every single optimal portfolio along the efficient frontiers. So what you immediately see is that if you were following the maximized Sharpe ratio, probably you would have been exposed to much more rebalancing. You see this portfolio is much more unstable because so we see we have ups and downs, and the biggest ups actually have been when just before the dot-com bubble, so you see there have been a big potential for huge returns. As well, you see the big drawdown after the financial crisis. Whereas if we take a look at the info ratio, well, do you see this dark blue region which seems to be much more stable across time? So you see that in fact your curve here seems to be much less volatile in comparison if you were following the other strategy. So this pinpoints some interesting aspects of this paper, meaning that we make a benchmark between two alternative strategies that would suit different types of investors. Finally, of course, we need to also take a look at the performance across time. So what these two figures tell you is the following. Maybe let's start with the left one. What it tells you is that if in 1992 you invested $1, if you were following the Sharpe ratio, today you would have made around $8 return. Whereas if you were following the risk-free rate, simply let's say you invested in a bond, throughout this entire time you would have almost doubled your investment, maybe even a little bit more. If you were holding the market, in other words, if you hold the S&P 500 index, you would have made slightly more than in fact the bond. So you see you would have been exposed to a lot of drawdown. You can also see it down there, a lot of fluctuation and volatility. Now let us take a look at the info ratio, and here please bear in mind the scale. As you can see, with the info ratio, we would have made less. We would have made approximately around $5. And as well, the risk-free rate and the S&P 500 would have delivered us, of course, the same return. These are simply benchmarks. So, and you can see also the bottom line here. On average, the return by following the max size strategy would have been approximately 12.26%, whereas if we were following the info ratio, it would have been 9.83%. The good news, however, here is that we managed to outbeat the market, and this is very important, which basically is a very strong signal that, in fact, this type of investing and taking into account this new estimator provides actually pretty good returns that could be a very good signal both for investors and the entire economy. So let me now summarize what I have told to you before just I conclude. So what we do is, first of all, we start by observing the asset universe. We start by targeting a specific list of stocks that we're willing to invest in. We observe them. And before we invest, we estimate of all these stocks the CAPM. Because from there, as you remember, the CAPM is an essential element in my estimator that I use finally in the model. So when we obtain all the REs from the CAPM, we plug it into my estimator, which was the key contribution in this paper and to the literature. So as you can see, when we plug them all here and we specify our gammas and REFs, what you get is in fact an expected return that then enters in the maximization problem. Next, what you do, of course, this is the maximization problem, and I have not bogged you down here in details. You can take a look at the paper because I think it's not very interesting to talk exactly about this probably not very nice equation. Finally, after we do this, the model will gonna tell us weights. In other words, how much shall we invest in each specific asset that we consider, basically in our asset universe. This is what I already showed you with these pie charts. Finally, when we obtain these estimates, we want to benchmark our strategy. We want to make sure that, in fact, what we're investing will be profitable, and we want to know, are we, in fact, are we doing good or not? Finally, when we do this, we observe the profitability, in other words, what-if analysis. If we did invest, how much we would have made across time. So finally, in order to conclude my speech, I would like to very briefly touch upon the main contributions I have done in this paper. So first of all, I managed to derive and propose a new estimator, a new return estimator that, based on the data that I have run through, seems to perform pretty well. And as you saw, the novel thing is that it involves three separate estimators. We have this additional element that is the forward-looking information. In other words, we want to be sure how confident we are in a specific prediction, whereas most of the other estimators, they take historical data. So in other words, they try with historical data to tell you the future. But I guess you probably well know that historical events are not a good predictor of future events. So that's why we somehow need to correct for this. And this estimator does it. The third contribution has been the incorporation of this improved shrinkage covariance estimator that has been there in the literature, but nobody has in fact combined it into one research. Finally, what we also observed that the max S and max I strategies both outperform the market. So this is, as I said, something positive, meaning that in fact we have done a good job, that we have been able to devise an investment strategy that is based on a rule that we always want to invest in these maximized ratios. Finally, however, we also saw that the max S strategy is more profitable than the max I, but this comes at a price. And the price is that you need to take higher return. Thank you very much for your attention. That was my presentation. Thank you.
Okay, judges.
I have a little, I need a little clarification. In your paper, you have mentioned about the shrinkage intensity.
Yeah.
0.75. What does it mean? How you explain that?
Well, can you please repeat the question about the intensity? Where did you see it?
You used in your paper 0.75 intensity.
Ah, okay, I see. Okay, I get your point. Okay.
So can you explain that?
Of course. So this intensity of the shrinkage estimator that you're talking about, of course, here you're trading off between an unbiased estimator and a biased estimator. As I said, the shrinkage estimator is a combination, a weighted average between an unbiased estimator, which is the historical covariance estimator, and another one, which is the so-called the single index matrix. This is basically what this entire covariance estimator is mixed of. So in order, you want to fit the prediction of this estimator as best as possible to the data. So in other words, you do a calibration, and this intensity is exactly this. You want to find out for what value of the intensity would this estimator match the data in the best possible way. So 0.75 is, in fact, if you run this estimator and you want to make sure for what value of this intensity would I get the best fit to the data, you get 0.75. Does that answer your question?
Actually, I was trying to get the information that what is the meaning of that? What does it explain to you?
The intensity is simply the weighted average component between the two parts of this estimator. So this is what it tells you, that you need to know how much to weigh each individual component of this estimator. That's it. And the optimal one to fit the data perfectly is 0.75. So if you run the calibration, you get this answer.
So I have two questions.
Yes.
The first one, so I guess you finished school about 6 months ago now.
Yeah.
So are you rich? Is Angie predicting your retirement?
I'm still not predicting my retirement, but I guess I would at least definitely give it a try because at least I think the good point is that the data shows this. So of course, maybe it may be worth investing and seeing whether if I follow my estimator and my strategies, how would that actually...
We will follow up with that. And Angie's data, there was like a bump that somebody who was like 24 years old in the 1994 data, and I'm like, gee, who is that? More serious question though,
Yeah.
and it relates to this actually. So real world application of this model.
Yeah.
Are there hindrances to actually doing this? I mean, whether you're a reasonably intelligent individual investor, or if you're a money manager or a sort of a financial planner or something, are there hindrances to using this sort of approach?
Of course, I think that's a very reasonable question, exactly because we have seen that in the last couple of years, relying on these type of mathematical models perhaps has led to very, very serious bankruptcies of many firms, among others Lehman Brothers and so on. So what I would like to say here is that this is in fact the thing that I have tried to correct by introducing this forward-looking component. In other words, the personal confidence of a return of an investor. So you personally, how much do you believe in this estimate? Because this is so important, and this has been lacking basically until now. What we only try to do is estimate future returns by combining past data. But how does past data predict future? I don't see the clear pattern. So that's why, of course, as you probably see, this REF is very investor specific. It's not one single number, and I think this is the good point about it, because you want to make sure that based on your market outlook, you take the best decision. Because then, as you probably can imagine, if everybody knew perfectly the future, then everybody would be very, very rich, and there won't be any poor people, right? Or, as you know, it's a zero-sum game. So the point is, you want to try to maximize your own return by, let's say, moving one step forward, kind of performing all these back testing, using this estimator and the covariance estimator to obtain better results.
I have a question
Yes.
about the transaction costs.
Yes.
How, you said you estimated 12 basis points for transaction costs?
Yes.
How'd you arrive at that, and what if that changes will in effect dramatically your predictor model?
Okay. So basically, if you, for example, many of the stock exchanges, I'll give you an example of the New York Stock Exchange. If you take a look at the transactions and you take the average broker commission and the average, you could say exactly, transaction cost involved in buying or selling a stock, you would see that the average is around 12 basis points. And I think this is the most fair way how you can go about it, because of course some stocks, may be more traded, so in other words, commission will be lower there in comparison to other stocks that are a bit more illiquid, so of course the transaction cost will be higher. So if you take the average, you'll get the number of 12 basis points. In relation to your second question, I think it's a very good observation, and this was in fact why I decided to show you two efficient frontiers, one having these constraints, the other one without. So what you immediately saw is in fact that the efficient frontier did not shift horizontally, but it drew down vertically. So in other words, when you account for transaction costs, this eats out of your returns. And as I said, it's also a good feature that we have included it, because now the model also tries to take this optimization decision in hand as well. It starts asking, shall I enter this trade, but in fact if I enter it, the return that I'm going to make will be smaller than the transaction cost. So that's the risk. If we do not account for them, we may end up actually having a negative return, and of course we want to avoid that.
Okay, and we're out of time, so I have no questions, but I do want to offer a suggestion.
Yes.
You used a improved shrinkage covariance estimator.
Yes.
And it would be nice to see the results without that, and
Okay.
one with it and one without it. Just because there's a lot of things going on.
Yeah, that's
You
true.
do have very good results when you do it, and you wonder which of the results are due to, say, the shrinkage estimator, or which is due to another part of it. So, but no, that's only a comment. Okay.
Okay.
You're all set. Thank you.
Thank you.
Okay, and our third panelist is Emily Jackson from Stanford University on Wikipedia.
Of you for coming to listen to my talk this afternoon. I'm going to tell you about the efficiency of Wikipedia's evolution. Previously, with printed encyclopedias, they had centralized production, they were produced for profit, and they paid their contributors. There's clear incentives to produce what consumers value. Now, with online open source encyclopedias such as Wikipedia, there's decentralized production, the articles are produced for free, and they do not pay their contributors. So it's unclear whether or not they're producing what consumers value. This is a substantial issue. As of October 2013, there are 29 million volunteered authored articles in 287 languages. There's 497 million visitors a month, and 42 million registered users. So given this magnitude and given the decentralized platform, it's unclear whether or not it's producing what consumers value. So what I want to understand is whether their page production is efficient. And there's many such examples on the internet, and I'm only looking at Wikipedia, but there are broader implications for this. First, I'm going to give you a little bit of background on Wikipedia, then I'll walk you through the data that I use in my sample, and I will then walk you through the three main perspectives that I look at. I start with whether or not the efficiency of page creation. Are pages that create or generate many views created first? Are pages that eventually link to by many others created first? And then I separate my sample into two groups, the pages created by frequent editors, which I define to be editors that create more than 10 pages in my sample, and infrequent editors who create less than 10 pages. And I want to understand if the pages they create differ. Wikipedia was launched on January 15th, 2001, and it was actually started as a side project of another online encyclopedia, Nupedia. Nupedia was trying to produce expert quality articles, and so they had a 7-step verification process of their articles, and so they created Wikipedia as a site where the authors could have live editing and peer review of the articles they're trying to produce on Nupedia. But Wikipedia actually just took off on its own. As you can see, the growth has been quite substantial over the last 12 years. There's over 4 million articles. These are the articles just in the English language Wikipedia, and there's over 4 million articles now. And if you compare it to a print encyclopedia, the topical coverage is quite vast. I use the entire Wikipedia edit history from 2001 to 2008. So this includes every page and every edit of that page that was created during this time period. So this includes information such as the page title, the creator, the date of creation and the editor and timestamp of every edit, and the categories that the page would be classified under, and a bunch of other variables that I don't use. Each page is viewed a certain number of times in 2011, and I use this as a proxy for readers' valuation of that article. Wikipedia, at least in my sample, has over 400,000 categories, so I thought this would be a little narrow, so I define 11 broad domains that cover roughly the topics. And finally, I also obtained the link structure between the pages, so I know which page is linked to which others. A major question that I ask is, did editors create the most viewed pages first? Spoiler alert, I find at a typical point in time, editors create roughly 80% of the maximum possible views that could have been created through that time, which is remarkable. And this is true both across domains as well as within domains. I'll walk you through the model that I use in this first perspective. So I have the set of pages that were created between 2001 and 2008. For each page, there's a time that it was created, as well as a number, and this number represents the importance of this page. So I use the page views in 2011. So for example, say their page on New York generates 20 million views in 2011, then it would be 20 million important. And a page on squirrel attacks only has 200,000 views, then it's 200,000 important. What I cared about was social importance, and I wanted to make the most people happy with Wikipedia, and I had the page of pool of all the pages, I would take the first most viewed page and create that first, the second most viewed page, create that second, and so on. So at a given point in time, if you summed up then you also have the pool of, the order in which the page were created. So if you add up the total of the views that were created at a given point in time, and you compared that to the total views that could have been created at a given point in time. So say you know the first 10 pages that were created, you have the total views that were created in the first 10 pages, and I want to compare that to the total views that could have been created if you created the 10 most viewed pages. And if you had the first 100 pages and you wanted to compare that to the first 100. So roughly my efficient measure is the actual views as a percentage of the possible views. I'll just walk you through a hard example just to make it a little clearer. Let's say that the first 3 pages that they created were Obama, Australia, and basketball. So the first page, they create Obama. This generates 8 million views. Then they create Australia, which generates 9 million views. So at the second point in time, they have 17 million views. And then they create basketball, and they generate a cumulative total of 20 million views. However, they could have created Google, Sex, and M&M, at which point they would have had 24 million, 50 million, and 54 million views. So through time 1, they created 33% of the total possible views. Through time period 2, they created 43%, and through time period 3, they created 37%. And this is just an example, these aren't. So this graph represents results for all domains. The blue line represents the total possible views that could have been created at a given point in time. The red line represents the actual views that were created at a given point in time, and the green line represents the least possible views. The difference between the blue and the red line represent the gains that could have been had from creating higher viewed pages earlier. So the area between the blue and the red line is the inefficient area, and the area between it cut off the words a little. But so my measure of efficiency is the percentage of the total area that's efficient, which would be the green over the red plus green. These are the actual results for the all domains. So this is looking at all the pages in my sample and not a specific domain. This is 77.6% efficient, which is quite remarkable. These are the results for the technology domain. This is the least efficient domain and is only 66% efficient. Technology, we live in a day and age where technology is being rapidly developed, and these are time-sensitive articles. For example, the iPhone was announced in, I think, 2006 or 2007, and it's not possible that that page could have been created before that time. So not clear what pages to create first. While landmarks is the most efficient category, it's 89% efficient. And take, for example, the Statue of Liberty, the Eiffel Tower. The popularity of these attractions have been relatively steady over time. Landmarks aren't things that are being developed or discovered very frequently, so it's pretty straightforward to create the most viewed pages first. This table shows the results for all the different domains. As you can tell, the results are consistent with the characteristics of the different domains. So as you would expect, movies is on the less efficient side. This is an area that, like technology, is changing. When movies are produced, it's likely that they don't produce the page until, say, the trailer is released or people know about the movie. It's important to consider not only the page's views, but how well connected it is. The link structure of Wikipedia facilitates how easy it is for users to move from one page to another, how easy it is to search for information, and it even gives readers information on other topics that may be related to what they're interested in. So I take connections into account as well. In this part of my model, I define time by half years. And in each time period, there's a set of pages that has not yet been created and a set of pages that have already been created. And I focus specifically on that set that has not yet been created. And within the set, there's a subset that will be created during that time period. And I want to understand what is influencing the decision for those pages to be created. So there's a probability that page I will be created during that time, and I define this to be a function of its normalized views, as well as the connections that page would have if it was created during that time period. So the number of its neighbors that have already been created, and I normalize both of these to have a mean of 0 and a standard deviation of 1 so that they're easily comparable. I use a logit model where I look at the function, or the probability is a function of views and connections, and I look at the percentage change in the probability of a page being created from a 1 standard deviation increase in views or a 1 standard deviation increase in connections. So I plug in the coefficients that I get from my logistic regression into this formula here, and then calculate the percentage change. These are my results. On the y-axis is the percentage change in the probability of a page being created. So as you can see in time period 3, there's roughly a 30% increase in the probability of a page being created from a standard deviation increase in views or connections. And then down in time period 12, there's only a 5% increase in the probability of a page being created from a standard deviation increase in views or connections. There's 2 main takeaways. You can see that this effect is decreasing with time. And the second point is that both are significant and substantial, and they're roughly the same line. And this is remarkable given that the correlation between views and connections is 0.21. So it is not the fact that they're capturing the same thing, they just both are playing a role. I now divide the group of editors into 2 separate categories, those who create 10 or more pages and those who create less than 10 pages. And I find that frequent editors create more viewed pages and infrequent editors create better connected pages. Again, the y-axis is the percentage change in the probability of a page being created. On your left-hand side, you can see that the percentage increase in the probability of a page being created from a standard deviation increase in views is higher for frequent editors, and the percentage increase in the probability of a page being created from a standard deviation increase in connections is higher for non-frequent editors. And these effects are, again, diminishing with time. Just to conclude, Wikipedia's page production is remarkably efficient. Editors create roughly 80% of the maximum possible views that could have been created through any point in time. And the probability of a page's creation is significantly and substantially increasing in its relative number of views and connections. This effect does diminish with time. And finally, frequent editors create more viewed pages, and infrequent editors create better connected pages. And I hope that the techniques that I've used here can be used to look at other websites and the internet going forward. Thank you.
Judges, who wants to go first?
I will.
Okay, Stephanie
So
will.
I have a question about the linkage.
Okay.
That you obtained the structure to see how pages were linked to other pages. And I may have missed this either in your paper or just now today, but does the number of linked pages affect the efficiency?
So what I was trying to get at with this is not, the link's not necessarily efficient, but kind of an idea of why the editors are creating the pages that they do. And you can imagine that the links create for users a sense of ease in terms of getting from one page to another. I don't have a direct number of what the efficiency is, but that was kind of the mentality that I was bringing into them. And it does seem that the pages play a role. And yeah.
Would you maybe be able to, without going out on a limb, predict that the number of links would also have an effect on the, because you said if there was
Yeah.
no link, that was a negative.
Mhm.
right? So if there was a link, that was a positive, and if there was more than one link, would it be a positive, a neutral, or an even higher positive?
So the number of links, I don't have an exact number of what, I do know that more linked pages are created first. And I would say from a personal standpoint, a higher linked page would be, so what I'm trying to do going forward is to calculate another measure and using the network structure and kind of value so that if you imagine the nodes as articles and to create a value of each page as well as its link structure and do some sort of eigenvector centrality and then so you would have a measure that took into account both the views and the links of a page and then go ahead and create a measure of efficiency that way, and that's what I want to do going forward. But I don't have an exact how the links now are efficient. Yeah.
Mohammed?
Okay, two questions. One is there any reason of cutoff time 2001 to 2008?
I used 2001, well, these are the first, I wanted a large sample, so I wanted the sample to be large enough, but I also wanted the pages to be in some way considered complete when I'm looking at the views, so that the views aren't biased based on a page just being created. And so the latest views that I could get were roughly 2011, so I wanted to have as many pages as possible for those views that wouldn't be biased by how close they were.
Okay, my next question is, your efficiency depends on views and linkage.
So
It's a connectivity.
I look at, my first measure looks at how efficient the view generation is, and then I separate it into how connections affect the probability of a page being created, but I have not looked at how that in a way affects the efficiency.
My question was,
Okay.
is there anything about authenticity or the accuracy?
The what?
How accurate is this pages? The
The
accuracy
Oh, the accuracy of,
of the pages or authors.
oh, the accuracy. Okay, I didn't look at this specifically, but there are a number of articles that do look at this, and they all find that the pages are quite accurate, and I think that's not surprising given the huge number of editors, and so the editors are kind of managing each other. So the editors can go in, and if someone puts some false information, then they go in and edit and change it to the right information. And so the site's largely reliant on the fact that it has a positive user base that is not trying to have malicious intent. But you can imagine at some point if there's less editors on, that they could put false information that wouldn't be caught.
Okay, So I'm still stuck on one clarification, and then I have a broad question. The correlation between views and connections, it's 0.21.
Yeah.
Because I had a question about that, and I didn't see it in the paper, and then I caught it
Yeah,
here.
yeah.
That's still just amazing to me that it's so low.
Yeah.
And it says something interesting, I think, about how people actually use the site.
Mm-hmm.
And something sad about how people use the site, actually. Okay. Why did you do this? How did this project come about? I mean, that's what I just really have to know.
Okay. Well, I was sitting in my advisor's office, and we were discussing a bunch of different websites, and in a class that I had taken with him, we had I think it was the CEO or founder of Quora come in. And it was really interesting to listen to him talk and how they had problems when they first started. So Quora is a similar platform, however, it's question-based. And so the issue that they had is when they first launched it, the demographics of the people that it was all Silicon Valley people that were kind of using it, and they were having issues diversifying what pages that they actually had on, or what questions they had on the site. And I thought this was really interesting in how the fact that they had difficulty kind of spreading out what they were covering. And so that led to us discussing other websites, and we got onto Wikipedia, and then we got onto how accurate it was. And eventually I started to think about, well, it would be interesting to see what pages Wikipedia has, because they're driven not by waiting for a question to happen, but anyone can just go create the pages, and just really what pages they're creating.
Okay. Well, if it's my turn, I have 4 questions, okay? This is a paper that just generates questions. I mean, you're thinking about things you thought you would never, encounter. But the first thing is, it's a comment, and it's not a criticism of your paper, because you didn't study the accuracy. But, that seems to be just below the surface. And I had the same problem Mohammed had. And as I'm going through it reading, I'm saying, the reason I read an encyclopedia is for accuracy. And, how accurate, efficiency is not equal to accuracy. So, and that's not a criticism because you didn't look for it. But I wonder whether or not the number of edits can't be tied back to accuracy. Because if somebody writes an article that is perfectly accurate, you would expect to have no edits. And we've all heard or read about profiles of people, and some might be derogatory, and then all of a sudden they get cleaned up, and then they get fixed back again, and you get a number of edits in there as they're arguing over what ought to be said about somebody. So I'm just thinking that maybe the number of edits could be tied in somehow to accuracy. Might want to think about that for another one. I guess, and my biggest question, I'll move on for the sake of time, is you think with an open source platform like this, we could create the world's largest economics textbook? Be possible? Yes.
Yeah.
Who wants to start it? Okay, we could all contribute portions to it. I mean, it makes
Well,
sense.
there's just an article, I forget where I read it, or a newspaper topic that I think it was some medical school in San Francisco that was actually having as homework, they were having their students go on and create Wikipedia articles as their homework. So I thought that was very beneficial for the public.
Well, yeah, you wonder about, types of applications this could have, and you just don't know. And last comment. You talk a lot about an article is found a lot, okay, the first time somebody finds it. But is that really a function of the way the web prioritizes things? Because if I go to Google something, all of a sudden Wikipedia articles come up at the top. And I know it's possible to raise the frequency of your views by, I don't know how you set it up. I have a website, I get ads from people all the time saying, hey, we can improve the hits on your website if you just pay us $150, and I ignore them. But, so that might affect the number of, hits that you have or the first time page views.
Okay.
Is that possible?
That is possible. I know that at least over time, Google has tried to adjust their algorithm in a way that, because they did that was a problem with Google's search rank for a bit of time, once people discovered that it was kind of a function of how many other pages referenced your page. And once they discovered this, they kind of adjusted their algorithm in a way to manage that, but there's still some of that. And I know when I was just trying to find articles on Wikipedia, it was hard, because when you Googled anything with Wikipedia, it would just come up with Wikipedia page on this, Wikipedia page on that, but it wasn't a specific article on Wikipedia, it was just referencing Wikipedia. But
I mean, it's something
Yeah.
you might want to think
Yeah,
about
yeah,
when
in
you're
adjusting for that.
summarizing, the importance of first-time views or something like that. Okay, well, thank you very much. Very interesting paper. And our last panelist this afternoon, and we are right on time, is Yi Yu, who came in from Beijing day before yesterday, or I guess maybe it was yesterday. Long haul to get all the way here. In another topic I didn't think anybody would ever take a look at, but
Good evening, everyone. It's a great honor for me to give you a presentation about my term paper with the topic of the deterrence effect of stand your ground law on crime in East U.S. states. Everyone cares about safety. We look for laws that can help protect ourselves. In the U.S., we have castle doctrine. It derives from an ancient maxim that a man's home is his castle. It states that if you have reasonable belief of an unlawful threat at home, you may justifiably use force to retreat first without any obligation. Stand your ground law is an extension of castle doctrine to places outside home and to make defense in other ways possible. From 2004 to 2009, 24 states passed stand your ground law. This law became a heated discussion when Trayvon Martin was shot in Florida. According to the police record, there was no indication that Martin was involved in any kind of criminal activity at the time of encounter. However, when the police arrived, Zimmerman told them that Martin attempted to kill him, and he shot Martin in self-defense. Even though stand your ground law was not used by Zimmerman's defense team in the trial, people still concerned whether stand your ground law does help protect people, or it just offers another excuse for gun abuse. What I try to do in my term paper is to answer the question whether stand your ground law has an effect on the decrease of crime rate. This is important because it helps us to decide whether we should abandon or encourage this law. According to the economic theory of crime, both the probability of being arrested and the potential punishment from the law may have deterrence effect on crime. Potential punishment not only comes after being arrested, but can also happen during the crime if the victim defends himself. Given the above analysis, the extension of castle doctrine may also have deterrence effect on crime. So this is the hypothesis of my paper that I will test later. Stand your ground law as deterrence effect to crime. When I refer to the literature, there's only one paper trying to answer the same question. This paper tries to find the change of crime rate after introducing stand your ground law. However, with state-level annual data and depth-in-depth identification analysis, it finds no effect of stand your ground law on the decrease of crime rate. This result contradicts to our traditional thought and makes the result itself to some extent a little vague. Does it mean that stand your ground law has no effect on crime rate, or may there be any potential problem? The self-selection in a law decision brought endogeneity problem, and the huge difference between different states, especially when we consider states in the East and West. make the control group and the treatment group not comparable to each other. So the DID analysis result may not be that reliable. So what can I do to fix these problems? The first thing I decided to do is to use county-level data instead of the state-level data. A state-level law is arguably more exogenous at the level of counties because a whole state will decide whether to pass the law or not only to fix the problem in a few counties, but to fix the crime problem at the state level. And it's also more comparable. The county-level data also makes the control group and the treatment group more comparable to each other. It's more likely that two similar counties have different treatment just because they are in different states. What's more, it also offers me more observations. The next thing I decide to do is to use the combination of synthetic matching method and diff-in-diff analysis. I will construct comparable control counties for each treated county and to make the control group and treatment group more similar to each other, except for stand your ground law. Here comes my identification strategy. In the first step, I will use synthetic control analysis to construct counterfactuals and to uncover the effect of stand your ground law for each treated county. In the second step, I will put all pairs of treated and synthetic control counties together and apply diff-in-diff regression to find the average treatment effect across all treated counties. I want to say a little bit more about synthetic matching method and its role in my research. A synthetic control county is a weighted average of potential control counties chosen to approximate the treated county in terms of the outcome predictors. The assumption here is that the crime rate of counties in stand your ground law states would have evolved the same way as that of counties in non-stand your ground law states in absence of the introduction of the stand your ground law. If the synthetic control county and the treated county have similar outcome behaviors over an extended period of time before the enactment of the law, the discrepancy of the outcome variables after the enactment of the law is viewed as produced by the law. So we can see the synthetic matching process as a reweighting of my control counties to assign more weights to counties that are similar and comparable to the treated counties and to assign less weights to counties that are not similar or not comparable to my treated counties. So the key work here is to calculate to find the optimum W to get the minimum value of this function. So x1 represents the characteristics of the treated county, and x0 represents the characteristics of the control counties. And here, my matching variables in x0 and x1 is listed as below. I include the annual violent crime rate since 1995 and the average demographic characters before the enactment of the law and the average employment rate for each county. And then this is my regression function. Y is the outcome of reported crime. Here I focus on violent crime rate because according to the description of different crime categories, violent crime is more likely to be confrontational, thus more likely to be affected by stand your ground law. D represents whether in year T county I passed stand your ground law. SI is county fixed effect and MT is time fixed effect. And X is a vector of time varying county attributes. Here I include demographic characters like sex ratio, youth percentage, risk percentage, and so on. And I use unemployment rate to represent the economic conditions. I also use the police agency numbers to represent the police deterrence effect. These are variables that may also affect the crime rate. So the average treatment effect of stand your ground law is represented by the estimation of beta 1. And this is a description of my data. Now it comes to my synthetic matching process. The problem I came through here is that I have too many control counties in my donor pool. Since I use data to match for each treated county, and this data allowed me to put no more than 209 control counties in the donor pool. And the donor pool means the control counties that I chose to match for treated counties. The first thing I decided to do is to constrain my sample to MSA central counties. This is reasonable because MSA central counties generally have larger population density and arguably more likely to be affected by stand your ground law. Besides, MSA central counties also have more reliable crime record. But it still leaves me 345 control counties in the donor pool. The next thing I do is to randomly draw around 205 control counties from the whole control county sample to generate 10 subsamples. I use each subsample to match to find a synthetic control county for each treated county. So after this step, I will have 10 synthetic control counties for each treated county. And I will find the best matching from the 10 synthetic control counties. The best matching here offers me the minimum value of the matrix value. The reason I do selection here is based on the concern that a subsample may not represent the whole control county sample that well. So a subsample generating a good matching for one county may not generate a similar good matching for other counties. So that's why I do the selection process. Figure 1 shows the MSA central counties I pay attention to in my sample. Counties with color red don't have stand your ground law, while counties with color green have stand your ground law. Figure 2 shows times of a county selected into a donor pool. We are glad to see that for each control county is selected into the donor pool for at least twice. Figure 3 shows the matching result for Florida Polk County. I use this county as a illustration of the matching result for my treated counties. At first, I intended to use the county where Martin's gunshot happened, but unfortunately, it happened in a non-MSA central county, so I don't have the matching result for that county. So I pick a county nearby. So this is the Polk County. Here, the ratio is defined as the relative difference of violent crime rate between the real treated county and the synthetic control county. We notice that before the enactment of the law, the ratio is basically around 0. It means that our matching is good for this county. And after the enactment of the law, the ratio trend went downward, indicating the effect of stand your ground law. Table 1 shows the counterweights in the synthetic Florida Polk County. So here we use the following control counties to generate the synthetic control county for the treated county. So for each treated county, we will have a table like this and a figure as shown in the previous slide. And this is the aggregated matching result for counties passing stand your ground law in 2005. I use this subsample as a representation of my general matching result. So again, basically, before the effectiveness of the law, the ratio is around 0. And after the enactment of the law, the trend went downward. And I use table 2 to show the comparison of violent crime rate predictor means in the control group and treatment group to show how successful the matching is statistically. So from the column 1 shows the characteristics for the treated county before the enactment of the law, and the column 2 shows the characteristics for the synthetic control counties, and column 3 just shows the basic characteristics for my all control counties without the matching process. Here we notice that column 1 and column 2 basically are similar to each other, it indicates that our matching is generally good. Now we get our whole samples, our treated counties with their synthetic control counties, and we can do the DID analysis. From column 1 to column 3, after including demographic characters, unemployment rate, and the police agency number, the estimation result indicates that stand your ground law helps decrease violent crime rate by 3.5%. One concern here is that counties passed stand your ground law in 2009 have only 1 year after post-law observation. It may reflect only a short-term fluctuation instead of a long-term trend increase or decrease. So what I do here is to drop this subsample and redo the DID regression. The result is shown in column 4, and basically it is consistent to the previous result. I also changed the time period that I observed. The result is shown in column 5 and column 6, and they are consistent to each other. The next concern here is that whether the result is driven by the synthetic matching process itself instead of the stand your ground law. So if our concern is true, then even if we do this to the control counties, then the result will be similar. So what I do next is to randomly assign a year from 2004 to 2008 to each control county, and I assume that that control county passed stand your ground law in that certain year. Then I use other control counties to generate the synthetic control county for this imaginary treated county, which is in fact don't have stand your ground law. And the matching result is shown in Figure 5. Figure 5 shows the matching result for both imaginary treated counties and the real treated counties that passed stand your ground law in 2005. Again, I use this subsample as a representation. We notice that for both imaginary treated counties and real treated counties, before the enactment of the law, the ratio is around 0. And we also notice that some counties have better matching than others, but I think it makes sense because we cannot guarantee that each treated county can have a good matching from our donor pool. And after the enactment of the law, we notice that for real treated counties with the green lines, the trend diverged, but the majority of them went downward. But for imaginary treated counties, even though their trend also diverged, but these blue lines generally are balanced distributed around the horizontal line. And if we apply DID regression to the imaginary treated counties with their synthetic control counties, we will get the result in column 3. And for the DID result for the real treated counties with their synthetic control counties is given in column 1. The comparison of column 1 and column 3 indicates that our result is driven by the stand your ground law instead of the matching process. The next thing I want to mention here is the result difference of synthetic matching DID and basic DID. The basic DID result is given in column 2. So with basic DID, I just put all the MSA central counties together, and I do DID regression analysis and get this result. The result difference verifies our intention in applying synthetic matching process to make our control group and the treatment group more similar to each other and to get more reliable result. And here are some further works that I think I can do to improve this paper. First, what kind of counties are more likely to be affected by stand your ground law? Because from the previous figure, we will notice that some counties will show a larger effect of stand your ground law than others. So this question may be interesting. And then I think I can also find other programs to do synthetic matching and use the whole control counties instead of my randomization method to draw a more solid conclusion. So this is the end of my presentation. Thank you for listening.
Judges.
You said that, okay, when you are selecting the county for economic, you consider the economic condition as
Yeah.
unemployment.
Yeah.
Did you take into consideration the educational and cultural background?
You mean the education background for the citizens in these counties?
Yes.
Yes, actually, basically, we need to include the education background in as the control variables. But unfortunately, I don't get these variables at the county level, so that's why I didn't include it here, because at that time I didn't find it.
Because I think your selection of county will be actually affected by the cultural background and the educational background as well in order to implementation of the law.
Yeah, I understand that. So I just try to include as many control variables about the demographic characters as possible, and I think it may, to some extent, alleviate this problem.
Thanks. I don't have the big broad question for this one that I wanted to. This is really important. And I'm shocked that there's only a little bit of work already done on standard ground laws, because obviously understanding how these things function, we should spend more time before we enact them, honestly. You know, we saw what happened with three strikes you're outlaws and the unintended consequences of those, which economists finally pointed out, and now a lot of those are being repealed, and we need to be sure that standard ground doesn't have some bizarre consequence like that as well. A couple comments. The decision to use MSA Central Counties, did you have evidence to back up your claim that they, I believe you said they're more likely, I've forgotten exactly how you said it, but they're more likely to have impact, or standard ground is more likely to be important in central counties, I think you said because of population density or something like that. Was that a judgment call on your point, or is there evidence you could point to that leads us to that?
Okay. The reason I focus on MSA Central Counties is just I thought they have higher population density. So I think basically in MSA Central Counties they will have higher crime level. So that's why I focus on these counties. And I think you can imagine that if a county has a low crime rate level before, it will be less likely to be affected. So that's why I do this step.
Okay. Let me suggest two counter arguments that might come into play. One, MSA Central Counties are extremely diverse in their nature. In fact, Polk County, since you used it as an example, Polk County is way less urban than Sanford County, where Trayvon Martin was shot. But it's not a central county. You know?
Yeah.
And sticking to Florida, Miami-Dade County is obviously dramatically different than Polk County, but they're still central counties, right? So just picking those, it seems, while there's a reason they're all together, it's really arbitrary because there's dramatic differences between what's a central county in the U.S. by definition. Second, I actually wonder whether there's more impact of standard ground in more rural places than in more urban places, because the rate of gun ownership in the United States is higher in rural locations than in more dense locations. And obviously you have to have a gun in order to shoot somebody using standard ground laws. So I actually think rate of gun ownership may be the more important factor instead of like population density in some respects. So I wonder about the urban-rural thing in terms of that. And because I don't want to take a lot of time. The other thing is I would wonder about different types of crime. Because you've eliminated property crime, and yet there are a lot of property crimes that would involve the potential for standard ground. Carjackings are property crime, and that would be a standard ground situation. Muggings are property crime, and that would be.
Yeah, may I have some comments about your on your last question last suggestion. Actually, I also do the synthetic matching and DID regression on property crime, but because of the space limit, I just delete that part. Yeah, and so about the property crime, I didn't find a significant effect of stand your ground law on the decrease of crime rate.
The problem, the way we break up crime is just bad, because there's no way to pull out which types of property crime also includes, fraud and things like
Yeah.
that, which are obviously not relevant. So.
Actually, what I wanted to do is commend you in the way you selected the types. She actually said violent crimes. Of course, fraud would fall into that category. But what you did in your matching of various counties, I thought was brilliant. And I also want to make a question about an improvement possibility. I realized that you had additional data that you left out. But in the table in which you identify the characteristics of the counties, and that would be table 2, the sex ratio, while it's obvious to you, it might not be obvious to the reader what you mean by the sex ratio, the percentage of males versus females, I suppose, in the county. And so it's hard to tell in the sex ratio whether there are more males or more females. And so I would just make an additional little identifier in that. Also, I wanted to say that it's wonderful to have timely economic analysis. So that was another very positive aspect of the paper that I saw. And then finally, in terms of explaining the standard ground law, I would make a recommendation that you explain it as the duty not to retreat and to use equal force, including lethal force. There's no recommendation about whether that lethal force is fists, knives, or guns in the standard ground laws. So I think that's an important fallacy. Some people associate it with gun ownership, but it can mean any type of physical defense. And I think that probably could be added as in the intro of this type of paper.
Okay, thanks.
Thank you very much.
Okay, and if it's my turn, I enjoyed the paper very much.
Thanks.
It was fun to read. And I thought at one time you imposed a value judgment on the selection of counties, and I'll read it here. It says, when a state passes the crime deterrence law, the criminals move across the border to its neighboring state. Now, I know you pulled that out of another article, but I can assure you that in my area, all the criminals are homegrown. And, I don't think you need to exclude a border county because you think the people are going to move out. And the fact that you did that is a value judgment, okay? I mean, I think you could look at all of the counties and not worry about that.
Okay.
And that's my value judgment, that all our criminals are homegrown, but anyway.
Thanks very much.
Okay, that's it? Any questions for anybody in the audience? Okay, if not, then what I'm going to do is go out in the hall for a few minutes with the judges and go through this. And thank you, everyone, okay? And we'll be back in a few minutes. Presentations. And as John Virgo always said at the end of this session, that we really have 4 winners here. The shame of it is that we have to say one was just a tad bit better than the other. But at any rate, on the 3rd ballot, okay, we decided that Boris would be the one that was the winner this year. So congratulations, Boris. And now, let me mention also that we're going to do something a little bit different this year. Catherine has an award she is going to give to the other finalists, and everybody will have a chance. The other three finalists will have a chance to submit an 800-word anthology of your report to the journal, and that'll be published. We'll put them all together in the same issue, and leave an email trail so that people can contact you if they want to get a copy of your paper. But all of you did a wonderful job. You really did, and we appreciate the efforts and coming to visit with us today and everything that went with it. So, Catherine, I'll turn it over to her.
So I just want to take a moment to congratulate all the winners as well. I think everyone's a winner. So on behalf of the International Atlantic Economic Society, I just wanted to give each of you your awards. So let's start with our grand prize winner, Boris. Congratulations.
And let me mention also, there is another journal that publishes student articles, and I'm going to get the web address and everything to you, email address, so that you can submit your articles if you want. They could publish your article in full, even though there's an anthology here. Is that correct? Okay. And in the past, I have also shared those addresses with the other finalists, and this journal's only 2 or 3 years old, but we've had one of our finalists in every single year have their article published. I mean, so it's very good. So, okay. The other thing everybody ought to know is that the finalists can take their plaques with them. There's a box underneath the table so that you can put it away and not, get it scratched. And I'm going to take Boris's back to him, back to our shop, and have the title changed from finalist to winner, and then we'll FedEx it to Boris in Denmark, and I will then FedEx just mail the bill to Kathy, right? Okay. Hey, thank you for coming, folks, and like to see you again next year if possible, okay? Thank you.